Good day, fellow investors. If you want to be a great investor, you need to know what to do. And especially in these difficult, volatile market times, I feel that a lot of people don't know what investing is. And in this video, I want to focus on that because that's the only thing that can help you survive these times, get stronger out of these times, and even compound wealth at a faster rate. Today we're going to discuss Lilu's 15 mental models for investors that have helped him really do great over time. We made this video discussing Lilu's last interview, but now I have summarized more from his various rare interviews over time to put things into a list so that you can see, okay, this is the core of investing. How does that fit you? Also watch the Lilu interview because it's really packed with value. Because investing works no matter what the Fed does, no matter whether there will be a recession, whether this or that, no matter what. Erase the noise, focus on fundamentals, businesses, and you will do well. There is no other. About Lilu, he is the manager of Himalaya Capital. He is the only person that Charlie Munger gives his money to manage for him, also finds ideas like BYD for Berkshire, and he did really well over time, plus 20% per year for a long period, which means he is one of the greatest investors out there. Now, let's go through the 15 things Lilu tells you have to know to be a great investor. The first thing, the market is created for speculators, not for investors. So we must take advantage from the market as investors. Don't fall into the speculative trap. Let's take an example here. Just let's take Tesla over the last year. Just look at the ups and downs. So from 600 up to, what is this, 1,200, more than 100%, and from then again down to 600, 700 again. That is the market, and nobody can tell me that here it was worth 600, then it was worth double in just 6 months, and then 6 months later it's worth again half of it. This is pure market speculation because everybody wants to buy something that goes up and not miss out, and everyone wants to sell something that goes down, and Tesla is really a great example of that. Because the market is designed for people who are flawed in their thinking and are attracted because they like to trade and make fast money. If you trade, you're bound to make mistakes, as emotions will assure that fear and greed open up the opportunities for value investors. If we look at the current fear index, this is it. Extreme fear now. So a year ago it was neutral, it was even bigger fear a month ago. So it goes up and down. If we just look at this and what it was a year and a half ago, it was extreme greed. And you can see here these extreme fear and greed periods measured by CNN, I think. It's really insane how this works. And then data shows that less than 5% of stocks are held by value investors. 95% of stocks are held by speculators, no matter the billions or the pennies they have. Most people are speculators, and that's how the industry works, and that's how the market works, and that's why they cater for them, not for you as a value investor. Also, if we look at the most traded stocks in Europe over May from the Hero, you can see here everyone is chasing that Tesla, trading it, or other companies. So really constantly chasing that stock performance instead of focusing on the businesses, owning it for the long term. No, it's always about trading. That's human nature, and we have to take advantage of it. And the way to take advantage of it is to think like a business owner, not a stock market speculator. So investment returns depend on the performance of the business, nothing else. And as Lilu says, don't think of yourself as a paper shuffler when you buy a stock, but as an owner of the business. Let me give you a Buffett example. Buffett owns Apple, Burlington, See's Candy, Berkshire Hathaway Energy, and many other businesses and stocks. Does he focus on stock prices going up and down? No, he focuses on how much those businesses make. And those businesses make 28 billion in cash flows directly to Berkshire, plus 8 to 10 billion in hidden earnings. Let's say 36 billion per year. If you are an owner, you focus on, okay, I have 36 billion created per year in value. How does that fit me as an owner? That's the mindset, not as the stock price of Berkshire goes up and down. We'll discuss this example through the video. And you can think as an owner, if you have a long-term horizon, what does Buffett think? Buffett thinks, okay, how I'm going to redeploy those 36 billion and invest them, compound them for more. Let's just put here 36 billion as initial investment, no additions anymore, length 20 years. Let's say Buffett aims for an 8% interest rate, and then let's see if he does, I don't know, 4 or 12. Over 20 years, his 36 billion start can go to 167 billion to 400 billion, 350. So that's the variance there. But he's focused on creating value, getting that money and reinvesting, and he'll likely do 8-10%. Thus, the current yearly 36 billion will be compounded constantly to more and more billions. And when you add each year of that, then you know what Warren Buffett is doing. And that's what you focus on. There will be ups and downs, there will be recessions, there will be everything, but you have to focus on what the business can do. And you have to train to think as an owner. That's why it's better to think as market cap, not really stock price. Because if we look at the stock price of Berkshire, it goes up and it goes down. But if you think as an owner, then you look at the market cap, 600 billion, you look at the 36 billion in value created over time, no matter what, and then you say, how does that 36 billion deal for me compared to the market cap? I'm an owner of Berkshire. Do I like the earnings? Do I like what they do with the earnings? And how does that add value for my long-term financial future? Because if those earnings compound, this is the answer. And you see how that compounds over time. Over the short term, yes, there are times when Berkshire goes down 40%. That's very, very normal. Even when other stocks go up, Berkshire goes down 40%. But you have to focus on the business. Those who focus on the businesses, those do well because earnings compound, not shenanigans, like it was the case here when everyone was selling Berkshire because there were other hot stocks. We all know how that dot-com story ended. Then we have to think as the market exists there to serve us, not to be guided from the market. Most people look at here, oh look, the stock is going up, Berkshire is a great business, buy, buy, buy. Oh, Berkshire is in trouble, the stock is going down. That's how most people look at things. But investors look, oh, Berkshire is cheaper, what's the earnings, what's the value of the business for me? It's much better to buy Berkshire here than to here. That's simply mathematics, that's logic, but 99% of people don't get it. And if you don't understand what you're doing, if you don't know the earnings, the business, how those things develop, and the price you paid compared to the earnings, then you will get destroyed by the market because the market is merciless when that happens. If you want to see when there are no earnings, when there is nothing, how merciless can the market be, just look at this. So those who don't know what they are doing, just following trends and living on exuberance and saying here how they expect 20% per year ahead from here, those usually get punished because they are not focused on the businesses, they are just gambling with other people's money. So that's what happens if you don't know what you're doing. And if you don't know what you're doing, then you usually buy here and sell here, because that's how things go. And I think that most people don't know what they are doing because they are investing in index funds because that's the thing to do and that's it. I don't want to think about it. But there will be trouble ahead. We discussed it a little bit here. Try to educate people. I try to do my best, and that's all I can do. And I thank you for your support. And now, what happens when your stock is down 50%? If you know what you own, then that is not a problem for you, even if you don't have much money to buy more, because you know that you have bought value. And it's normal that stocks fall. Ray Dalio says that at any given moment in time, an asset class can crash 70%. So I'm always ready for my portfolio to crash 70%. and then see how to go about it and how to build wealth from there. I know it will happen. Berkshire crashed 50% from top tick to bottom tip every 12 years over the past 5 decades. That's a given. And the key is that even if you don't have any money, if you have a good business and you are a good investor, you can sit through watching your portfolio down by 50% and not being affected at all. So that's something that can happen, and everybody will start thinking it's terrible, my portfolio is down, things are terrible, but actually things are on a discount, you will get some dividends, you'll reinvest, you will accumulate more wealth over time, and that's about it. 8. Stand on your own. This is very important. I have a research platform, many customers, and many are following me in what I do, but I always tell them we are all different. I can explain the risk and reward of your investment, but you have to understand how it fits you. Because sooner or later, any position can turn against you, and if you don't have any insights into the business, the risk and reward, and what you took and how it fits you, when it goes from 100 to 50, you aren't going to know if it will be back to 100 or 200. That's the problem. That's the issue I have with people just following, but I try to do my best and educate so that they know the risk and reward and then see how that risk and reward fits them. Now let's go on how to find businesses to own. When an opportunity presents itself, here is the checklist. Is it cheap? Depending on your returns that you can get from the business. Is the business good? Berkshire is a great business, for example. Is the management trustworthy? Is there enough external validation for that, Buffett, for example? What else am I missing? Why it is cheap? Why does this opportunity exist in the market? I made a video here that Berkshire will deliver 10% over the next years, that Berkshire is trading at a P/E ratio of 10 and it will not trade again that soon. But why did this opportunity represent itself here? Because everyone else was chasing other things that will do much better over time. So everything was here very, very hot, doing great. It's time for the new world to come, and therefore they were selling Berkshire as they did here, because there was something else and Buffett is old. That's why the opportunity was there. And then of course it's to be curious about businesses, about investing in businesses. How much money does Burlington Northern Santa Fe do for Berkshire? Do you know? If you don't know, then you don't invest in Berkshire. They're just investing in the stock price going up and down. Around 6-7 billion per year, if you must know. So be curious, be a researcher, look at things, learn more about the things that impact your business, read everything, and over time you will accumulate enough knowledge to know about investing. That's it. You have to put in some time. And then of course apply value investing, 4 concepts there, because value investing works no matter what. So you are a business owner, look for a margin of safety, and the market is there to serve you, not to guide you. What's your circle of competence? So stick to your circle of competence. We didn't discuss yet the margin of safety for the principles. What does it mean? So the margin of safety is a methodology, and price is what you pay, value is what you get. If you get more value than what you have paid, then you have a margin of safety. Value is, yes, uncertain, so it should be priced at the lowest possible price. Low price equals good margin of safety if you buy good businesses. I like to define it, worst case scenario for the business, am I still okay with as an investor? So if the price is that low, that is pricing in the worst case scenario, no growth for Berkshire a year ago when 10% earnings yield, P/E ratio of 10, am I okay with 10%? Yes, and then you buy. That's a margin of safety. And then don't get confused by volatility on the market. The market goes up and down, but you have to focus on the business and how that business is evolving. Those are slow changes, but if you're focused on the noise on the market, you miss those slow business changes. Berkshire cash flows doubled. This is not including the hidden earnings from the stocks over the last decade. Revenue doubled, so no matter what was the ups and downs over 10 years, you can see here how revenues doubled. And if we look at the stock price, it quadrupled over that tripled over the last 10 years. Now it's a little bit more exuberant, but here it was in line with the double of the revenue. So everything follows the business and the compounding. If you buy at low prices, you have a margin of safety. And at the end, it's all about you. You have to be independent, unemotional as much as you can, be patient and extremely decisive when there is an opportunity to invest in. That's how it works. Ask yourself questions about the business, about investing, and of course, you must understand the power of compound interest, the eighth wonder of the world. And the answer for the average person is, even if you find something that will compound at 6-7%, Berkshire now 8 or 9%, you will seize it because you know this could be the most important opportunity of your life. That's his advice for the average person if the prior 14 tips are too difficult. So I really hope you enjoyed this Lilu 15 mental models in this market. This is the core of everything. So thanks for watching, and I'll see you in the next video.